General Electric is actually outside of our coverage. I focus primarily on the heavy machinery stocks, so agriculture, construction, mining, and trucks, more so like Caterpillar and John Deere.
So that said, let me start with you on Deere, Ashish, and ask you
Sure.
about their latest earnings report. Basically, there was a lot of negative macro issues affecting the company, right? They had the poor crop season, the flooding. They've had soybean sales coming way down from previous levels. Why are the shares rebounding today?
I think what you're seeing today is a little bit of optimism around corn and soybeans. Both of those are up, along with the stock market. And perhaps there was some positioning issues into the quarter with people who were a little bit more negatively inclined. Maybe the results weren't as bad as expected, even though sales missed, earnings missed, and they reduced the full year outlook. From our perspective, the risk reward is roughly reasonably balanced. We're neutral rated, looking at the trade war and the larger than expected crop, which we found out from the USDA last week, offset by potential that crop is actually overstated in size, and perhaps you could get prices of corn moving back up as we look into the later part of the year. And we're in an environment where the U.S. and Brazilian tractor markets are very depressed relative to history.
Let's play a little would you rather, Ashish. Would you rather Deere or Caterpillar? I'm guessing you're going to say Deere, in part because there are more pressure points for Caterpillar. If the global economy is slowing and the commodity cycle is slowing, they would be more exposed to that kind of business than, I would guess, Deere, not to mention the China trade issues.
Yeah, that's 100% right, Tyler. We think CAT is in a negative earnings revision cycle at this point. We have a sell rating on the stock, and you could kind of point to price to earnings and say, oh, maybe the stock's cheap here. But what happens when you get into these negative EPS cycles is that earnings are tough to forecast, so you end up needing to look at a price to sales multiple, and that would kind of be somewhere around a 0.6 to 0.7 times, which would imply about 30% lower from here. We don't know how quickly things are going to deteriorate, so we're not that negative yet, but the overwhelming risks are to the downside there. We don't really see any incremental drivers of demand improvement outside of mining, and mining is heavily reliant on global macro holding up. On the side of Deere, which we would be more inclined to be positive on, 30% of the sales are from construction, 70% are from agriculture and turf. So the fact that within agriculture and turf you have depressed North American, Brazilian markets, we think there's room to be more positive. And if we got a rebound in corn and soybeans based on potential for a trade deal or a smaller than forecast crop, we would be inclined to get more positive.